Two people can earn completely different salaries and still have the opposite financial reality from the one you expect. Meet Maya and Evan. Maya earns $55,000 a year. Evan earns $100,000. If salary is the scoreboard, Evan is winning by a mile. But Maya has no consumer debt, 6 months of emergency cash, a good pension, and room left after every paycheck. Evan has a newer car, a more expensive apartment, $38,000 of consumer debt, and less than 1 month of essential expenses in cash. The higher salary is real, so is the weaker financial position. Today, I'm going to show you 3 numbers that reveal more about financial strength than salary alone. They measure what you can keep, how long you can survive a disruption, and whether your future income is taking shape. These are planning tools, not universal rules. Your taxes, family, health, location, and benefits can change every result. But once you know these 3 numbers, a salary stops being a status symbol and starts becoming what it really is: one input. Number 1 is your monthly margin rate. Start with the money that actually reaches your accounts after taxes and payroll deductions. Then subtract the outflows you must cover to keep normal life running: housing, utilities, insurance, basic food, transportation, childcare, and minimum debt payments. What remains is your monthly margin. Now divide that margin by take-home pay. That percentage is your margin rate. The Consumer Financial Protection Bureau describes cash flow as the timing of money coming in and money going out. Its research has also found that people who report a regular saving habit are less likely to have difficulty paying bills, and that pattern exists across income levels. Here is the simplified comparison. Maya's illustrative take-home pay is $3,650 per month. Her required outflows total $2,750. That leaves $900, or roughly 25% of take-home pay. Evan brings home about $6,100 in this example, but his required outflows reach $5,800. His margin is only $300, or roughly 5%. Evan earns much more, yet one car repair, rent increase, or insurance bill can consume his entire monthly gap. This does not mean Maya's life is easy, or that everyone can produce a 25% margin. Required spending can be high for legitimate reasons, including medical care, dependents, and expensive cities. The useful question is not, is my percentage perfect? It is my margin positive, repeatable, and large enough to move my next goal forward? If the answer is no, look first at the biggest fixed commitments, not 10 tiny purchases. Housing and transportation together represented more than half of average consumer unit spending in the latest Bureau of Labor Statistics data. That does not make the national average your budget. It tells you where the largest levers usually live. A raise helps when part of it remains margin. A raise that immediately becomes a larger car payment or higher rent may change the lifestyle without changing the financial structure. Number 2 is your emergency runway. Take liquid cash that is genuinely available for emergencies and divide it by essential monthly expenses. Do not count a credit card limit. Do not count a retirement account you would have to raid, and do not count the market value of your home. If you have $12,000 in emergency cash and essential expenses of $3,000, your runway is 4 months. Maya has $16,500 set aside and essential expenses of $2,750. Her runway is 6 months. Evan has $3,500 against essential monthly expenses of $5,800. His runway is about 0.6 months, or roughly 18 days. That difference changes how each person experiences the same bad news. Imagine both employers announce layoffs on Friday afternoon. Maya still has decisions to make, but time is on her side. Evan may need a new paycheck before the next billing cycle ends. The Federal Reserve reported that 55% of adults had rainy day funds sufficient to cover 3 months of expenses in 2025. It also found that 63% could cover a $400 emergency using cash or its equivalent. Those statistics are context, not a command that every person must hold the same amount. Your runway should reflect job stability, household size, insurance, health, transportation, and the people who depend on you. A stable two-income household may choose differently from a freelancer, a single parent, or someone with an older car and a high deductible. The key is to measure emergency cash in months of your expenses, not as a random round number. $10,000 can be a long runway for one household and a few weeks for another. Number 3 is your retirement coverage. This number asks whether the income you are building for later can cover the spending you expect later. Begin with reliable monthly estimates, such as a vested pension and your personalized Social Security estimate. Then add a cautious estimate of income your invested assets may support using a retirement calculator or qualified professional rather than a promise from a thumbnail. Finally, divide that future monthly income by projected retirement spending measured on the same dollar basis. Do not compare a future inflated benefit with today's grocery bill. Use today's dollars on both sides, or future dollars on both sides. This is where Maya's pension matters. Her statement estimates $1,800 per month at retirement. Her current Social Security estimate at her planned claiming age is $1,600 per month. Before counting her retirement account, those two estimates total $3,400 in projected monthly income. Evan has no pension. His Social Security estimate is higher at about $2,650, but he has only $45,000 in his workplace account and $38,000 of consumer debt today. Neither example proves who will retire comfortably. Both people still need to test claiming age, inflation, investment returns, taxes, healthcare, and longevity. But the coverage calculation exposes information the salary comparison completely missed. Vanguard's 2026 Workplace Plan report showed an average account balance of about $168,000 and a median near $44,000. That enormous gap is why an average account balance should never become your personal target. Your retirement target comes from the future spending you need to cover and the reliable income resources you are actually building. A pension is not cash in the bank, and a retirement account is not guaranteed monthly income. But ignoring either one because it does not appear in annual salary can make a financially stable person look weaker than they are. Now, put all three numbers on one page. Margin rate tells you whether the present is creating room. Emergency runway tells you how much time you can buy when life interrupts the plan. Retirement coverage tells you whether today's work is building tomorrow's income. Salary can improve every one of them. More income is useful. But income only becomes financial strength when some of it stays available, some of it becomes protection, and some of it reaches the future. Here is the 10-minute check you can run this week. First, use the last 3 months of actual transactions to estimate take-home pay and required outflows. Calculate the margin and the percentage. Second, divide emergency cash by essential monthly expenses. Write the answer in months and days. Third, collect your retirement account balances, pension statement if you have one, and personalized Social Security estimate. Compare projected income with projected spending on the same dollar basis. Do not use the numbers to shame yourself or someone earning less. Use them to choose the next move. A negative margin may point to a fixed cost or income problem. A short runway makes emergency cash the priority. Weak retirement coverage tells you to examine contributions, employer match, pension rules, and your time horizon. The goal is not to look richer than the person next to you. The goal is to build a financial life that can absorb a bad month and still fund a good decade. In the next Cody Invests episode, I will calculate how much emergency cash different income levels may actually need, using expenses instead of one generic savings target. Subscribe if you want that breakdown, and comment with the number you are improving first: margin, runway, or retirement coverage. This video is educational and uses simplified fictional examples. It is not individualized financial, tax, or investment advice.